Continuing with topic 2 of paper 12, we are going to look at 7 more asset classes. So previously we looked at the first asset class, equities. We're now going to look at 7 more. Now, under 2.2, the next one is fixed income securities. Now, these are securities that pay usually a fixed income, a fixed interest rate, although we can have a floating rate. But let's look at the details. These are interest-bearing loans where the investor lends money. So you're buying, for example, a bond. You're lending money to a company at a certain interest rate. Now, that will be the coupon rate for the life of the loan. Now, a coupon rate can either be fixed or floating, but the most common type in the markets is fixed, and that's what we will be studying. Now, a preference share, which gives a fixed preference dividend, commonly considered to be a fixed income security in substance, and you will receive the dividend regardless of operating performance. Debt securities with terms of 1 year or less, we refer to those as bills or paper, and they're traded in the money market. Now, in the US, Treasury bills of a maturity of 1 year or less, Treasury notes between 2 and 10 years, and Treasury bonds, these are loan instruments issued by the government of more than 10 years. Now, in Hong Kong, we have the exchange fund bills, which have a maturity of 1 year or less, and the exchange fund notes a maturity of 2 years. Now, could those come up in the exam? They could be referred to. So be aware they're a form of fixed income security. And governments, government agencies, supranational organizations such as the World Bank, the Asian Development Bank, they too can issue bonds. Moving along to bond pricing. Now, this gets very technical. What is the price that a bond trades at in the market? And it's the present value of the expected future cash flows. Now, this is very difficult with floating rate bonds, but is very straightforward with fixed rate bonds. That first bullet point on page 2.11, please score that out. That refers to equities and should not be there. It reads, usually provide high returns over the long term. No, so please just score that out. First bullet point should be the price value of a coupon security, as I've just said, is the sum of the present values of all future cash flows. Now, those future cash flows will comprise of coupon payments and the principal repayment. So if you were to buy a $100 bond, then you will receive $100 back at maturity. Let's look at an example just to work through the numbers. There's an outside chance you might have to do this in the exam. So we state that a 3-year 10% coupon bond with a face value of 100 Hong Kong dollars, providing a yield of 8%, will be priced at $105.17. Now, where did that 105.17 come from? That's the price in the markets. Well, it's a function of the coupon rate, the face value, and the amount that you will receive on maturity, which will be the face value. So over a 3-year period, you're going to receive 3 coupons and the principal repayment. So you can see you'll receive $10, $10, $10, and finally 100. Now, what we do is we discount those future cash flows back to present value, add up the present values, and that is the market value of the bond. Now, we calculate the present value of cash flow by taking the cash flow and dividing by 1 plus the interest rate. Well, that's the yield that you wish to receive. And in this example, it's 8%. So the first cash flow, $10, is divided by 1.08 raised to the 1 year. That denominator gives us a discount factor of 0.926 for 1 year, 0.857 for 2 years, 0.794 for 3 years, which we use twice. So we apply the discount factors to the cash flows. We bring those future cash flows back to today's value, present value, add them up, and we get 105.17. Now, the way to interpret this is to say that I am willing to pay $105.17 to receive those for cash flows when I require a yield of 8%. Moving along to 2.2.2, duration, the concept of duration. This is a measure of bond price sensitivity to changes in interest rate. Now, please be aware with fixed income securities, if the interest rate goes up, the bond price goes down, and if interest rates go down, the bond price goes up. Now, that first bullet point tells us it's a measure that approximates the percentage change in a bond price for a 1% change in interest rates. So the duration, let's say it's 6. What does that mean? Well, if the interest rates went up 1%, the bond price would go down 6%. Can also be thought of as average number of years it takes a discounted cash flow to be returned. Okay, so, that is a view, but I would stick to the first concept, this bond price sensitivity. Now, the next set of characteristics you must know for the exam. The longer the term or the time to maturity, the higher the duration. The lower the yield, the higher duration, and the lower the coupon, the higher the duration. Now, that's just the way that the whole thing functions. You may wish to try and understand it, but certainly just memorizing that will help you in any question in the exam. And then we're told the bond portfolio can be immunized by matching duration of assets and duration of liabilities, thereby meeting the target rate of return, regardless of price or interest rates. If duration comes up at paper 12, it will be one question. Characteristics of fixed income securities. They provide a steady income stream, unlike equity, where dividends may fluctuate. With a fixed income bond, you get that coupon every period. The income is known in advance. You can plot it, you can forecast. It's ideal for funding future liabilities, future expenses, because you know what's coming in. It's less volatile than stocks, although if interest rates are moving, if interest rates are volatile, then the bond prices will be volatile. Securities issued by governments, large corporations, will have high liquidity. Smaller corporations may not be as liquid. Value is heavily influenced, as I've said, by interest rates. Now, top of page 2.12, we're told that if you're investing in fixed income securities, you're going to be exposed to credit risk. That is not so much with governments, but with corporates. If a corporate went bankrupt, then you're not going to receive any interest or principal. Interest rate risk, that is the risk of interest rates moving. For a bond investor, the risk is that interest rates go up, because if they go up, bond prices come down. And industry risk, that's yield spread. So that's the difference between the yield on a corporate bond and the yield, for example, on a government bond. Now, to reflect the pattern of interest rates, we have a concept known as the yield curve. Will this be examined? Yes, there is a high chance this could come up. Again, it would be one question. Now, the yield is its effective annual return, express a percentage of the current market price, and it's determined indeed by a number of factors. If I understand the yield curve, we don't have to worry about all the underlying factors. Now, the higher the yield, I'm just repeating myself, the lower the price, lower the yield, the higher the price. Yield curve is a line plotting the yields of selected benchmark securities of the same type. So it's often government bonds, government securities, or corporate bonds. And the yield curve will plot the yields for different maturities from short to long term. And yield curves are considered by country, by market, used to forecast future direction of interest rates and inflation. So you could have a yield curve for US government bonds, for UK government gilts, for the German Bund, etc. So how are the yield curves shaped? Well, the first one there, positive or normal, that's an upward sloping yield curve. And there we're expecting the interest rates to increase over time. And conceptually, that reflects the idea of increasing inflation. Negative or inverse yield curve is the opposite. We expect future interest rates to fall, and inflation may not be an issue. This can occur when a government hikes interest rates, or rather a central bank hikes interest rates, then your short-term yields will be higher than the long-term. But when the interest rates come back down, then you may move to the positive or the upward sloping yield curve. And a flat yield curve, well, can reflect expectation of a stable interest rate over a number of years, but it's often the change between a positive to negative or negative to positive that it'll move through a flat stage. Next, asset class, hybrid securities. Now, this is a security that combines characteristics two or more financial instruments. A classic would be a convertible bond, where you've got an option to convert into shares, and it's also a fixed income security, a bond. Contingent convertible bonds, known as COCO bonds, they've become popular since 2014. And a COCO bond will automatically convert into equity. So you reduce your debt, you turn it into equity, and it's not the investor that decides. This would be automatic given the makeup of the instrument, where preset finance threshold is met. It's usually a capital requirement, maybe a gearing ratio is exceeded, and then automatically a certain bond issue will turn into capital, share capital. Next asset class under 2.4 is property, buildings, etc. And that is the ownership of real assets. Different sectors of the property market that fund managers can invest in: commercial, retail, shops, industrial, factories, residential, hotels, that is tourism, and rural, and the example we state there is plantations. Now, property can be large, sizable. So many small fund managers gain access through syndicates or listed property trusts. Now, investing a portion of a balanced portfolio in property can reduce total volatility, as it tends to be steady income. Derivatives, the next asset class. These are financial instruments where the price is based on the value of an underlying asset. This enables risk to be transferred from one party to another. So if you lock in a certain price with a derivative, you're guaranteed the price. It's the other party that is exposed to the risk. And accordingly allows future prices to be set in the present. We're going to consider some of these derivatives in a moment. They are traded through a formalized exchange, or rather those derivatives that are traded through a formalized exchange are referred to as exchange traded instruments. And we'll see that those are futures and options. Those derivatives traded outside of the exchange are known as OTC, over-the-counter instruments. And examples of OTC: swaps, forward rate agreements to do with interest rates, and over-the-counter options. Now, at the top of page 2.14, we're given a little bit more detail on the two main exchange traded derivative types: futures. Now, a future is a contract where you're agreeing to buy or sell an underlying financial instrument, or indeed a commodity, at a specific price. And with futures, It's rare to actually go ahead with the buying or the selling of the underlying asset. Contracts are usually closed out through a reversing trade. So if you bought a future at 100 and closed out by selling at 90, then you make a $10 loss. You're effectively locking into a price. Contracts available in Hong Kong include equity index, individual shares, interest rates, renminbi, and commodity futures. On the other hand, an option provides the holder, the buyer, with the right, not the obligation, to buy if it's a call option, sell if it's a put option at a specific price, that is the exercise price. Now, fund managers use options in many ways, including they buy call options as a cheap way of purchasing a share in a rising market. Well, instead of shelling out for the full price of the share, you pay the premium price of the option. The price goes up in the market and you enjoy the increase by selling the option later and making the return without having to spend the full share price. Buying put options, where the share price is expected to fall. So if you buy a put option, it gives you the right to sell the underlying security, let's say at 100, and when the price is in the market, let's say go down to 90, you exercise that option and sell at the higher price. You're locking into a higher price. And options can be used to hedge a position. Well, that's just what I've described. That is a common use of options, just as insurance policies are hedging against risk of loss in the future. Buying an option is similar. You pay the premium. If the market goes against you, you exercise. And if it doesn't, well, you just absorb the premium as a cost of doing business.